Are you feeling a little deja vu lately? You're looking at the crypto charts and it just feels like 1999 all over again? Well, you're not alone. That fear of a massive crypto bubble just popping, it's real. But, fear without a plan is just anxiety. So in this explainer, we're going to give you that plan. A survival guide for investors, built from what we've learned from past bubbles and the, let's say, unique risks of today's market. This quote from a retail investor on Reddit, it just perfectly captures the mood right now. It's this wild mix of excitement and total disbelief. I mean, when even the joke coins are skyrocketing and it feels like every single bet is a winner, that's a classic sign of market mania. This is exactly what people were saying back in the day about any company that just slapped a .com in its name. All right, so here's our playbook. We've got 5 parts. We're going to start with the anatomy of a bubble, then dive into crypto's hidden fault lines. After that, we'll give you a due diligence checklist, a strategy for surviving a crash, and finally, we'll look at what the next digital era might actually look like. Okay, first up, the anatomy of a bubble. And to really get a handle on where we might be going, we've got to look back at the clearest echo from the past, the dot-com era. The parallels are, well, they're pretty uncanny. Back in the late 90s, you had this irrational exuberance fueled by super easy access to online brokers. Fast forward to today, and it's apps like Robinhood that have just thrown the floodgates wide open. Back then, celebrity hype added fuel to the fire. Today, a single tweet from someone like Elon Musk can send markets into a frenzy. It's literally the same human psychology, just playing out with a brand new technology. So, how does this actually happen? Well, there's a neat little framework called the bubble triangle that really helps explain it. It says you need 3 things. First, marketability, assets that are super easy to trade. Check. Second, money and credit. That's the fuel, things like low interest rates. Double check. And finally, speculation, the spark, usually from some new tech. With crypto, all 3 sides of that triangle are, without a doubt, firmly in place. But here's the thing. Crypto isn't just a simple repeat of the past. The whole digital nature of these assets creates brand new fault lines, dangers that are totally unique to our time. Let's start with security. Take a look at this number, $2.5 billion. That's the projected annual loss from hacks by 2025. And you know what the really scary part is? The attackers are getting smarter. They're now targeting individual users like you and me with phishing and social engineering, not just the big exchanges. And it's not just hackers from the outside either. The system itself has some serious vulnerabilities. This represents a single price manipulation scheme on a decentralized exchange. It was worth $47.5 million, and it was orchestrated by just 4 large accounts, what people in the space call whales. And here's the direct cost of that manipulation for everyday investors. In just 1 hour, retail traders lost $7.1 million as forced liquidations just cascaded through the system. This shows you just how fast the average person can get completely wiped out by the actions of a tiny few. You see, all these individual risks are all connected. They create what one source calls the crypto domino effect. A tiny flaw in a smart contract can cause a run on a stablecoin, which creates a liquidity hole, and that triggers cascading liquidations across the entire DeFi ecosystem. We literally saw this play out with the collapse of Terra USD, which just vaporized $40 billion and sent shockwaves through the whole market. All right, the risks are clear. So how in the world do you find the projects that might actually survive a crash? Well, it's not about guessing. It's about having a systematic process. It's about due diligence. Here's a simple but really powerful 4-step framework to help you separate the real projects from all the hype. It all starts with a white paper. Then you look at the team, you assess the tokenomics, and finally, you examine the community. So for step 1, just remember this. Real white papers don't read like marketing brochures. A good one is technical, it's detailed, kind of like Chainlink's. A huge red flag is a project like Pepecoin, which just comes right out and says it has no actual value. You have to always look for substance over style. Next up is tokenomics, which is just a fancy word for the economics of the token. You have to ask a few key questions. Who owns the tokens? If a huge chunk went to early investors, that could lead to heavy selling pressure down the road. What can you actually do with the token? If it has no utility, it really has no reason to exist. And finally, is the supply capped or can it just be inflated away into nothing?
Okay, so once you know how to spot a good project, you can start thinking about strategy. This section is all about how to build a portfolio that's resilient enough to actually survive a market-wide crash.
The very first step is all mental. You have to reframe what a crash is. Don't see it as an endpoint, see it as a generational repricing event. It sounds simple, but that little mental shift changes your focus from pure panic to strategic opportunity. So, what might those opportunities look like? Well, this table shows a model for how to think long term. For each asset, there's a clear thesis, like Ethereum being a core settlement layer. But just as important, a key risk is identified right alongside it. And remember, this is not investment advice. It's a framework to help you do your own analysis.
But here's the thing, a strategy is totally useless if you can't execute it. The single biggest threat in a crash is your own psychology. Panic is the enemy, and the only defense against it is having a predefined rules-based system. Think about it. In a 90% drawdown, doing nothing is an active choice to accept a massive loss. A framework is how you fight that fear.
So here are a few examples of what that rules-based system might look like in practice. These model portfolios show different allocations for different risk appetites: defensive, barbell, and growth. The absolute key here is that buffer allocation to stablecoins. That's what allows you to rebalance into riskier assets when prices are low, instead of panic selling at the bottom. Okay, finally, let's just zoom all the way out. After the crash, after the dust settles, what gets built? We're going to look beyond the bubble into what could be the next digital epoch. One of the most powerful long-term trends out there is the tokenization of real-world assets, or RWAs. This chart shows you the potential scale. The market is projected to grow from around $24 billion today to a staggering $30 trillion over the next decade. This is the kind of massive, fundamental utility that could be built on the survivors of a crash. And that brings us right back to where we started. The dot-com bubble popped, sure, but the internet didn't disappear. Companies like Amazon and eBay, the ones that were solving real problems, they survived, and then they thrived. The ultimate lesson here is that technology is just a tool. The real, long-term value comes from what you build with it. Now, to continue your own research, here are some absolutely invaluable tools and sources that came up in our research. You can track on-chain data with DeFi Llama, monitor risk with dashboards from AS Invest, follow governance debates in protocol forums, and stay on top of the critical regulatory landscape with reports from places like PwC and the Financial Stability Board. So we'll leave you with this question to chew on. When all the hype dies down, when the tourists go home, and the market finally resets, what gets rebuilt? Because the answer to that question is what will determine the entire future of digital finance.